Asia was not ready. The refineries were not ready. The trading desks were not ready. The energy ministries of the nations whose entire industrial base, whose entire transportation infrastructure, whose entire agricultural supply chain depends on the continuous, reliable, predictably priced flow of crude oil from the Gulf to the processing facilities that convert it into the fuels and the petrochemicals that modern Asian economies cannot function without, none of them were ready for what Saudi Arabia just did. And the specific form of their unreadiness, the particular way in which Asian energy markets have been caught wrong-footed by Saudi Arabia's latest move in what is becoming the most consequential restructuring of the global oil market in a generation, tells you everything about the gap between the analytical frameworks that Asian energy planners have been applying to Saudi behavior and the actual strategic logic that MBS is executing with a consistency and a sophistication that the caught-off-guard community is only now beginning to fully appreciate. This is not the first time Saudi Arabia has surprised Asia. The previous analysis documented the surprise production increase that caught global analysts off guard, the specific move. That neither the trading desks at the major commodity houses, nor the research departments at the premier financial institutions, nor the energy ministries of the most analytically sophisticated governments had seen coming. That surprise was significant. The reaction it produced, the market repricing, the position adjustment, the frantic retrospective analysis that tried to explain in hindsight what had been missed in prospect, was the specific market response of an analytical community that had been caught on the wrong side of a major directional move. What Saudi Arabia just did goes further, deeper, in a direction whose implications extend beyond the immediate oil price mechanics into the structural architecture of the global energy market in ways whose consequences will be felt not for months, but for years. Not just by the trading desks and the refinery procurement managers and the financial analysts whose immediate professional problem is repricing their positions and updating their models, by the energy ministers who are discovering that the strategic framework within which they have been planning their nation's energy security is no longer adequate to describe the world Saudi Arabia has just created. Asia was not ready. Let us examine precisely what it was not ready for, why it was not ready, and what Saudi Arabia's latest move means for the specific countries, the specific markets, and the specific strategic calculations that are now being forced to update in real time. What Saudi Arabia has done is not simply a production decision or pricing decision in the conventional sense that OPEC market management involves. It is a structural repositioning, a deliberate, comprehensive, strategically integrated reconfiguration of the terms on which Saudi crude reaches Asian markets. A reconfiguration that affects not just the price and the volume, but the specific mechanisms of pricing, the settlement currencies, the contract structures, the delivery arrangements, and the long-term supply relationship architecture that together constitute the full framework within which Saudi-Asian oil trade operates. The specific elements of the reconfiguration, taken individually, are each significant. Their combination is transformative. The first element is the pricing mechanism shift. Saudi Arabia has announced the expansion of its yuan-denominated pricing for a significant portion of its Chinese crude sales, moving beyond the pilot arrangements that previous analyses documented into a formal, institutionalized mechanism whose scale makes it a structural feature of Saudi-Chinese oil trade, rather than an experimental accommodation to specific Chinese buyer preferences. The yuan pricing expansion is the specific element of the reconfiguration that has most directly surprised the Asian market, because the analytical community had been modeling the yuan-denominated pricing as a diplomatic gesture, as a marginal accommodation to Chinese political preferences that did not fundamentally alter the dollar architecture of Saudi oil pricing. That modeling was wrong. The yuan pricing expansion announced in Saudi Arabia's latest move is not marginal. It covers a volume of crude that, at full implementation, represents a significant enough share of total Saudi-Chinese trade to constitute a structural shift in the settlement architecture of the world's most important bilateral crude oil trade relationship. The implications of that structural shift extend far beyond the China bilateral. Every other major Asian crude oil importer is now watching the Saudi-China yuan pricing arrangement with the specific attention of governments that understand what Saudi Arabia's willingness to accept yuan settlement for Chinese crude means for their own bilateral currency discussions with Riyadh. If Saudi Arabia accepts yuan from China, the specific argument for why it cannot accept rupees from India, or won from South Korea, or yen from Japan, arguments that have rested on the foundational assumption of dollar primacy in Saudi oil pricing, is a fundamentally weaker argument than it was before the yuan expansion was announced. The non-dollar pricing architecture that previous analyses traced in its developmental stages is moving into its implementation phase at a pace that Asia's energy planning frameworks were not modeling. Asia was not ready for the speed. The second element of the reconfiguration is the contract structure shift. Saudi Arabia has offered to a specific set of Asian customers whose strategic importance to Saudi Arabia's long-term positioning has been identified and whose relationship deepening is a priority of the strategy this analysis series has documented. Long-term supply contracts whose specific terms represent a significant departure from the standard monthly official selling price mechanism that has governed Saudi crude sales for decades. The long-term contracts being offered contain several innovations, whose combination is the specific offer that Asian customers were not ready to process. Volume guarantees at scale, specific commitments to supply volumes over multi-year periods that provide Asian refineries with the planning certainty that monthly OSP mechanisms cannot provide in a volatile market environment. Price stability mechanisms, formulas that smooth the price volatility that spot market adjacent pricing exposes customers to, whose specific design reflects Saudi Arabia's understanding that the price volatility management benefit is a key element of what Asian industrial planners value most in an energy supply relationship. And critically, currency flexibility provisions, the specific contractual accommodation of non-dollar settlement options, whose formal inclusion in long-term contract structures makes the non-dollar pricing architecture not just a bilateral Chinese accommodation, but a structural feature of Saudi Arabia's full Asian supply relationship architecture. Asian energy ministries that have been managing their crude procurement through the established monthly OSP mechanism, whose simplicity and transparency have been features rather than limitations in the energy planning frameworks of most Asian governments, are now facing a Saudi Arabia that is offering something more complex, more relationship intensive, and more strategically loaded than the monthly pricing mechanism. Something that requires decisions not just about procurement efficiency, but about strategic alignment, about which of the long-term supply relationships available in the Asian crude market best serves a given country's full range of energy security and geopolitical interests. The decision about whether to accept Saudi Arabia's long-term contract offer is a decision about strategic alignment in ways that the decision about whether to accept the best available monthly OSP price is not. Asian governments that were not expecting to face this decision in the current period were not ready for the strategic weight it carries. The third element of the reconfiguration is the infrastructure investment linkage. Saudi Arabia has announced a series of downstream investment commitments in Asian refining and petrochemical infrastructure. Investments in the specific refinery and processing capacity whose development gives Saudi crude preferred access to the specific processing pathways whose economics are most favorable to Saudi crude's specific quality characteristics. The downstream investment linkage is the specific instrument that converts a supplier relationship into a structural integration whose depth goes beyond the commercial into the specifically technical. When Saudi Arabia invests in Asian refinery capacity, specifically designed to process Saudi crude grades, it creates a processing infrastructure dependency, the specific condition in which the refinery's operational economics are maximized by Saudi crude and degraded by switching to alternative crude sources, that sustains the supply relationship independently of the ongoing competitiveness of monthly pricing. This structural integration through downstream investment is the specific long-term relationship architecture that Saudi Arabia's strategy has been building toward. The conversion of a supplier relationship that rests on competitive pricing into a structural integration that rests on aligned economic interests at every level of the supply chain from wellhead to refinery output. Asian refinery operators who have been thinking about crude supply relationships in terms of monthly pricing optimization are now facing a Saudi Arabia that is offering them a different kind of relationship, one whose economics extend from the crude purchase price through the processing efficiency to the product output quality in a fully integrated framework that makes the comparison to alternative crude suppliers more complex than monthly price comparison allows. Asia was not ready for the depth of the integration being offered. Now let us examine the specific Asian country reactions, because the aggregate description of Asian unreadiness obscures the specific ways in which different Asian actors are processing the same Saudi move through their distinct national frameworks. China's reaction is the most complex because China is simultaneously the primary target of Saudi Arabia's Asian strategy, the primary beneficiary of the yuan pricing expansion, and the actor whose response most directly shapes the strategic logic of every other Asian country's calculation. China was less surprised than the headline suggests, because China has been in direct engagement with Saudi Arabia on the specific architecture of the long-term relationship that Saudi Arabia is now publicly implementing. The yuan pricing expansion did not arrive as a surprise to the Chinese central bank officials and the state oil company procurement managers, who have been negotiating its specific parameters with Saudi counterparts for the preceding period. What China was not ready for is the pace of public implementation, the speed at which Saudi Arabia has moved from the bilateral engagement to the public announcement that converts the bilateral arrangement into a structural signal to every other Asian country about the direction of Saudi oil market architecture. China's response to the public announcement has been the specific combination of public endorsement and private reassessment that the announcement's implications for China's own energy relationships demand. Public endorsement because the yuan pricing expansion serves China's long-standing interest in renminbi internationalization and in reducing Chinese energy import exposure to dollar financial system dynamics. Private reassessment because the long-term contract and downstream investment elements of Saudi Arabia's broader Asian reconfiguration have implications for Chinese competitive positioning in Asian energy markets that are not straightforwardly aligned with Chinese interests. A Saudi Arabia that is building structural integration with Indian, South Korean, and Japanese energy infrastructure through downstream investment and long-term contracts is a Saudi Arabia that is reducing the specific Chinese advantage that has come from being the primary relationship partner in Saudi Arabia's Asian strategy. China's private reassessment of what Saudi Arabia's broader Asian move means for Chinese strategic positioning is the calculation whose outcome most directly shapes how the Saudi-Chinese relationship evolves from its current moment of public alignment. India's reaction is the one that most directly reflects the unreadiness that the headline describes. Indian energy planning has been operating on a framework that assumed Saudi Arabia's Asian strategy was primarily a China bilateral development, that the yuan pricing and the relationship deepening were features of the Saudi-China relationship, whose implications for India were secondary and manageable within India's existing energy procurement framework. The long-term contract offer, the downstream investment linkage, and the non-dollar pricing currency flexibility that Saudi Arabia's latest move extends to Indian customers are forcing a complete reassessment of that framework. India is now confronting a Saudi Arabia that is offering it the same structural integration relationship, the long-term supply security, the price stability mechanism, the downstream investment, that it is offering China, but on terms that require India to make the same strategic alignment decisions about currency settlement and long-term commitment that accepting the offer demands. India's energy planning framework was not built to make this decision. Its procurement institutions are optimized for competitive monthly price comparison, not strategic relationship evaluation. Its currency policy framework has not fully incorporated the specific question of rupee-denominated crude settlement in the specific terms that a formal contractual commitment to Saudi Arabia would require. And its geopolitical framework, the specific management of simultaneous relationships with the United States, with Russia, with China, and with the Gulf states that Indian strategic autonomy requires, has not fully worked through the implications of a deep structural integration with Saudi Arabia for each of those other relationships. India was not ready for the depth and the speed of the decision that Saudi Arabia's latest move is forcing on it, and the specific diplomatic scramble visible in Indian Energy Ministry communications in the period since the announcement, the urgent consultations, the reassessment processes, the specific engagement with Saudi counterparts seeking clarification about the terms and the timeline, is the behavioral expression of exactly the institutional unreadiness that the headline describes. Japan and South Korea are processing Saudi Arabia's move through the specific frameworks of two advanced economies whose energy dependence on Gulf crude has historically made them the most compliant and least strategically complicated of Saudi Arabia's major Asian relationships. Both nations import the majority of their crude from the Gulf. Both have long-standing procurement relationships with Saudi Aramco that predate the MBS era by decades. Both have energy planning frameworks built on the assumption that Saudi crude would continue to be available on terms that the established monthly OSP mechanism defined. Saudi Arabia's reconfiguration of those terms, the long-term contract offer, the downstream investment linkage, the currency settlement flexibility, is forcing both governments to engage with this strategic dimension of their energy supply relationships at a depth that the established monthly procurement mechanism had not previously required. The specific question that both governments are confronting is the currency settlement dimension, whether accepting Saudi Arabia's non-dollar pricing options as a formal contractual feature of their supply relationships creates compatibility issues with their alliance obligations to the United States and with the dollar-centered financial architecture of the international economic framework within which both economies operate. The answer to that question is not obvious. Its implications extend far beyond energy procurement into the specific management of alliance relationships that Japan and South Korea's security frameworks depend on, in ways that are difficult to separate from their energy supply relationships. Neither Tokyo nor Seoul was ready for the alliance management dimension of an energy supply decision. Saudi Arabia's move has created exactly that complication. Now, let us examine the broader market implications of what Saudi Arabia has done, because the specific market dynamics that the reconfiguration is producing extend beyond the bilateral relationships with individual Asian customers into the structural architecture of the global oil market. The pricing mechanism shift, specifically the yuan-denominated settlement expansion and the non-dollar currency flexibility in long-term contracts, is beginning to produce observable effects in the specific market mechanisms that have sustained dollar primacy in global crude oil trade. The petrodollar system, whose foundational architecture rests on the specific convention of dollar-denominated crude pricing, is not collapsing. But it is bending under the specific pressure of the world's largest conventional oil exporter, formally institutionalizing non-dollar settlement options for a significant share of its production. The bending is visible in the currency markets. The specific reaction of the dollar index to Saudi Arabia's yuan pricing expansion and the non-dollar contract flexibility announcement has been the reaction of a market processing the signal that the world's most important commodity trade is becoming less exclusively dollar-denominated than it has been for 50 years. Not a crisis-level reaction, a measured, directional reaction, whose persistence and whose accumulation into a structural trend is the specific mechanism through which currency market implications of petrodollar erosion manifest. The forward curve implications are the dimension that oil market professionals are focused on most intensively in the immediate aftermath of the announcement. The specific shape of the crude oil forward curve, the relationship between near-term and longer-term crude prices, is being affected by the long-term contract commitments that Saudi Arabia's reconfiguration involves in ways that the spot market dynamics that dominate near-term price discussion do not capture. Long-term supply contracts at specific price formulas affect the forward market by creating the specific informed supply commitments, whose volume removes uncertainty from the longer-term price formation process. Saudi Arabia's long-term contract expansion is therefore not simply a commercial arrangement. It is a market structure intervention whose effects on price discovery and price risk management across the full crude oil price curve are being incorporated into forward market pricing in real time. The geopolitical market premium that has been a feature of crude oil pricing throughout the Gulf crisis period, the specific additional price that buyers pay to reflect the risk that Gulf disruption will reduce supply availability, is being affected by Saudi Arabia's reconfiguration in ways that cut in both directions simultaneously. The structural supply security that long-term contracts provide reduces the specific supply uncertainty that geopolitical premium reflects. But the non-dollar pricing architecture's implication for the dollar's role in oil market settlement introduces a different category of financial market uncertainty that the geopolitical premium has not historically been required to price. The net effect of these opposing influences on the geopolitical premium is the specific question that sophisticated market participants are working through with the urgency that the announcement's timing demands. The Russia dimension of Saudi Arabia's Asian reconfiguration is the element that connects the oil market story most directly to the broader war narrative that this analysis series has been tracing. Saudi Arabia's structural integration with Asian refining infrastructure through downstream investment is the specific mechanism that most directly and most permanently displaces Russian crude from Asian markets. When Saudi Arabia invests in Asian refinery capacity optimized for Saudi crude processing, it is not simply competing with Russian crude for the next month's market share. It is creating infrastructure whose economic logic permanently favors Saudi crude over alternative suppliers, including Russian crude, for the operational life of the downstream asset whose design reflects Saudi crude's specific quality characteristics. The Russian crude that is currently displaced from European markets by sanctions is competing for the same Asian market share that Saudi Arabia's downstream investment is structurally capturing. The displacement of Russian crude from Asian markets, not through competitive pricing alone, but through structural integration that makes switching back to Russian crude economically suboptimal, even when Russian supply becomes politically available, is the specific long-term mechanism through which Saudi Arabia's reconfiguration is imposing the most durable possible financial pressure on the Russian war economy. This is not simply taking market share this month. It is structurally capturing market share for the duration of the downstream assets whose development Saudi Arabia's investment is funding. Russia's energy ministry is processing this dimension with the alarm that the structural nature of the displacement warrants. The specific internal communications, expressing concern about the long-term implications of Saudi Arabia's Asian downstream investment for Russian crude's Asian market position, are reaching Western intelligence through the channels that Russian institutional information management can no longer fully seal. And their content reflects a strategic assessment that the problem being created is not one that Russian competitive pricing or supply reliability improvements can address within the relevant timeframe. The strategic dimensions of what Saudi Arabia has done in the Asian oil market are the dimensions that matter most for the long arc of the story this analysis series has been tracing. Saudi Arabia is not simply making oil market moves. Saudi Arabia is executing the strategic transformation of the global energy order whose foundations MBS began laying with Vision 2030, and whose full expression is now becoming visible in the specific form of a non-dollar pricing architecture, a structural Asian integration through downstream investment, and a long-term supply relationship framework. that is simultaneously deepening Saudi Arabia's strategic relationships with every major Asian energy importer and displacing the Russian and Iranian supply dependencies, whose strategic leverage has been one of the most consequential sources of instability in the global energy system. Asia was not ready for the full dimension of what Saudi Arabia has just done. The refineries were not ready for the contract terms. The energy ministries were not ready for the strategic decisions the contracts require. The currency managers were not ready for the settlement framework implications. And the geopolitical analysts were not ready for the speed at which the structural transformation of the global energy market is being executed. Saudi Arabia changed the oil game, again, faster than Asia expected, in directions whose implications extend far beyond the oil market into the full architecture of the global order, whose restructuring this analysis series has been documenting from its beginning. Asia was not ready. It is catching up now. But the specific ground that has been covered while it was not ready is ground that cannot be recovered.